In this week's update, amazing US earnings season, lithium stocks continue charging, Bitcoin being squeezed, and the start of an educational series. My name's Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. And when I started this doing these weekend videos, which was probably about 14 or 15 years ago, my intention was to provide a factual perspective on what markets are doing, and that's never easy to find elsewhere, because often it comes with some sort of bias or vested interest. And in addition to that, most investors tend to have strong beliefs or biases at a subconscious level that get in the way of clear thinking. So my intention was to provide a perspective that would be very helpful for those that wanted to embrace it, and just help you negotiate the markets with more clear thinking. Now, Portfolio Analyst, which I started about 4 years ago, has been heavy on education as well as other things, portfolios and recommendations, and obviously having questions analysed. But I wanted to introduce a bit of that education into this weekend series as well. So I'm starting a series that'll probably run for maybe between 6 and 10 weeks, and just stepping you through the hierarchy of my thinking, the way that I think about the market every day, every week. Now this week, I'm going to start at the biggest picture level and address how much exposure you should have to the market at any point in time, and where to have that exposure, more importantly. So more on that towards the end of the video. So just a bit of a perspective on the market at the moment. Short-term, perfect timing can't be done, because a lot of the time when you're trying to trade short-term, the movements are nothing more than just random backwards and forwards, and they don't really mean very much. But medium-term, I'm absolutely convinced that if you become skilled at technical analysis, that you can time the market to a very helpful degree, and that's what I'm going to be covering in this educational series. We need to pay attention to, obviously, sector rotations, where the money's going, relative strengths. These are all important things that I'll be addressing. Now, looking at the earnings season in America, which is really getting into top gear now. Last week had a lot of earnings reports, a lot of the big tech stocks reported. We've got 2 more weeks of very heavy reporting, and then it starts to fizzle down. But US earnings so far have been amazingly strong, and the outlook statements, so where the CEOs see the companies going, are more important than ever, because a lot of stocks have run up hard into earnings, and good earnings are not enough, as we saw with Amazon. There needs to be good forward guidance as well. And generally speaking, the outlook statements have been extremely positive. There's been a couple of examples where they weren't, and the share prices got hammered accordingly. So we've seen predominantly enthusiastic support for stocks that have reported. Those that have missed in any way have been punished. And I want to take a quick look at 3 of the American majors: Amazon, Apple, and Advanced Micro Devices. So let's take a quick look at those. So we'll start with Amazon. Big picture, we had a tremendous trend. We broke out above this level around 3,560. And the company has beaten on profit line, but they missed on revenue, and they also reduced their guidance on revenue as well. Now, we'd come back and we'd retested the breakout, had a little bounce, but not a lot of enthusiasm behind it. And then the result came in and was a surprise to Wall Street, and Amazon fell 9 or 10% on Friday night. Apple came out also with a good result, beat on both top and bottom lines, and whilst the share price hasn't really responded, it hasn't fallen either. So at this stage, Amazon, minor breakout, we're getting a consolidation, and it's just sitting there. But the one that, and there's many examples of this, but the one that really impressed the market and surprised the market was Advanced Micro Devices, AMD, which is a major in the semiconductor area. Great results, and look at the breakout and look at the volume associated with that. Now, in the short term, as I said earlier, timing is to get timing spot on in the very short term is incredibly difficult. So this price might continue straight on, or it might come back and retest. You have no way of knowing at this stage. But the overwhelming odds with a breakout like this is that the price of Advanced Micro is going significantly higher over the next 3, 6, 12 months. So incredible diversity in the American reporting season. So let's look at the market. The S&P was lower by 0.4% for the week, and a lot of that occurred on Thursday and Friday. Earnings season continues. It's very impressive. There was a Fed statement meeting during the week. They held their ground. But another thing that I would note is that the market breadth is waning. So small caps are struggling to a degree. Not all, but many. And the market breadth is seeing that narrowing is never a particularly good sign. Now the stimulus remains. The Senate have approved a $550 billion package for infrastructure, but it's from my understanding is it's not even going to be close to being enough. So you can probably expect more stimulus in that regard. The US dollar was mildly lower to 92.17. We saw the 10-year yield still basically tracking down to 1.23 from, only a few months ago it was 1.75, and everyone was convinced that it was going up. And that indicates, at least as far as the bond market is concerned, that inflation is just a transitory event. The VIX was slightly higher to 18, but not a lot of change there. So let's take a look at those charts. So there's the S&P big picture. On a daily, you can see it was really not much more than a consolidation last week. And considering that big miss by Amazon, the market held up pretty well. I thought it might have been down by more than that. If we look at the NASDAQ, NASDAQ also, all our moving averages, the 20, the 50 and the 200 are all aligned in the right area, and the price is above all of them. So both those major indices remain in very, very strong uptrend. But if we switch over and look at the small caps, you can see this is the band of support that I indicated. We did go to the bottom of that band and we bounced, but there's not a lot of momentum. And you're now seeing the moving averages. The 50-day is almost rolling over now through the 200-day. So clearly the market is losing momentum at the small cap level. So that's something to be watched, and it certainly does fit with the seasonality that we're seeing at the moment. All right, the US dollar, it's really just in a big band between 89 and 93, as it has been for quite some time. And we're just getting, it was down for the week, but we're just getting really a bit of backwards and forwards. The Aussie dollar, we're getting a little shelf of consolidation here, but you can see, you'd have to say that we're in a downtrend. The 200-day moving average is now rolled over. The price is significantly below it, and that's all we can say at this point in time. That it's now in downtrend. If we look at the Australian index, still looking pretty solid. So we've got the 50-day moving up strongly, the 200-day. So the Australian market's still looking quite solid, and obviously very good results for BHP and Rio and Fortescue, which have helped the market as well. So just to recap, our dollar just under 73 cents, and our index was pretty much flat on the week. Turning now to precious metals, gold was up $13 to $18.15, but look, it's just going backwards and forwards. There's not really been a great deal of change, as you'll see from the chart in a minute. And GDX may be a bit of a positive glimmer. GDX did a little bit better than gold did in the last couple of days. So if we look at US dollar gold, you can see that's on a weekly chart, so not a lot of change last week. And if we look at it on a daily, you can see it's pretty much the same. It's just backwards and forwards. This is Bitcoin. Now, Bitcoin finished the Friday session at 42,231, and there's certainly reports around that there's a bit of a short squeeze going on here because so many people had positioned themselves to for the break of this support at 30,000. Well, the net result is we've had a strong rise. It did ease back into the weekend, back to about 41,500. But look, there's so many cross currents in the cryptocurrency area at the moment. It's a bit of a casino, I got to say. Let's just quickly look at GDX. So GDX, you can see we gapped up on Thursday, and we managed to hold it. So 3 pretty good days to finish the week for GDX. So that's quite a positive sign. Other commodities, copper was higher to $4.41, and also nickel was stronger as well to $8.89. I'd throw in there lithium as well. If you look big picture at lithium, it's at the start of a very rapidly rising period of deficits that'll probably go for 5 to 10 years, and that deficit, based on the research that I've done, is set to become quite extreme. So whilst it's it's easy to ramp up the supply of lithium, as we saw in 2016, 17, 18, and sort of swamp the market, there's two things that are very different now. Europe in particular is demanding that lithium is sourced from green processes, and there's not very much of that percentage-wise. A lot of them come from what you'd have to say is a dirty process. Of course, the other thing is that the demand now is just skyrocketing with the takeoff in not only electric vehicles but also storage batteries as well. So the outlook for lithium is incredibly robust, and it's similar for nickel and flake graphite and cobalt. So any of the battery materials, the outlook is really, really strong, and it's become starkly evident in the last 6 months. Now, crude oil moved higher to 73.81. Not a lot to add there. There's the spot copper chart moving up, and also the nickel chart. We're now almost up to $9. Okay, let me now start this educational series with some of the bigger picture, the investing game plan. And what I'm going to be going through in this series is just the way that I think about the market, every week, starting big picture and working my way down to the individual stock level. There is little point, in my view, in trying to adjust your exposure or adjust your game plan based on the fundamentals, because the fundamentals lag too much. Markets look forward. They are responding well ahead of the economic data or whatever fundamental data that you're using. So trying to use fundamentals to time the market or to maintain your exposure or change your exposure is really a complete waste of time. And I think it's worse than not thinking about it at all, because it does put a bias in your head. And it leads to numerous illogical outcomes. So I would urge everybody not to use the fundamentals as a basic timing tool. And if you look at some of the examples, there's just hundreds and hundreds of them. Just when everyone was convinced that inflation was a problem, when yields got up to 1.75 and 99% of people were convinced that yields were going to 3% and the stock market would fall over, well, guess what? Bond yields fell. We're now down to 1.2. Gold fell, which shouldn't really be happening if it's an inflationary environment. And financials that would have done or do well in a rising inflation environment, they started underperforming, and the stock market held up. So all the predictions based on the fundamentals basically didn't come to pass. And so if you'd aligned your portfolio with what you thought was going to happen, then you were completely on the wrong leg. The reality is that everything that we need to know is in the price charts. It's no more complicated than that. And if you can become reasonably accomplished in reading the price chart signals, then you can do much better in the market than otherwise would be the case. So let's start with where and how much exposure. So the first question really is a bull or bear market. And very frequently in this video, I talk about the fact that we're in a secular bull market that started in 2013 and is likely to continue till probably at least 2030 and perhaps beyond. And that's because the average length of a bull market is around 18 years. So that gets you to 2031 just on the average, and there's other reasons to suspect that this bull market could be sustained for longer than that. Now, equally importantly is that along the way there'll be several bull and cyclical bull and bear markets. So I'm almost convinced that we will see some 20, 30, 40, 50% falls in the market between now and 2030. So this is not plain sailing, and for most people just buying and holding is not the preferred option. So it would be really helpful if we could get a bit of a warning gauge on where markets are going in periods of say 6 months or 12 months or a couple of years, because that then allows us to decide when we play hard, when we've got most of our money invested, and when not to. And if you can move your portfolio around, change the focus of your portfolio depending on where the money flows are going, where the relative strengths are, then that's a huge advantage. The key thing here is, I think in a secular bull market, you want to stay reasonably invested throughout, but it's a matter of how much, when do you raise cash, how much do you raise, and then what sectors do you go into when you decide that the market is appropriate to play hard again. We can use relative strength to advantage, and I've talked about that a few times in this service, but talk about that a lot in Portfolio Analyst. The US sectors are the benchmark, and we'll take a look at how we can use those sectors to get a guide on where the relative strengths are. And of course, using megatrends. The megatrends are providing the highest long-term probabilities. You want two things. If you want to do well in the market, you want two things. The first is that you want high levels of growth, because growth covers up a lot of short-term issues. So you want high levels of growth, but the second thing is you want high probability that growth is going to materialize. There's a lot of companies out there that have got huge potential, but most of them never realize it. So you've got to have those two things going hand in hand. So it's not just about growth, it's about how probable it will be. So let's just take a look at a couple of charts. And we'll start first of all with a couple of charts that I like a lot, and I show in this service, and that's the weekly spreads. So this is consumer discretionary versus consumer staples, and I've put it on a really big picture chart going back to the year 2000, and it shows us where the money is flowing. And when we're in a positive bull market, then consumer discretionary stocks are outperforming consumer staples stocks. So you can see from 2001 to December 2003, so about 2 years, consumer discretionary stocks were outperforming consumer staples. So as long as that continued, then we were pretty much in a positive orientated market, and you would be looking in the sectors that were more aggressive than defensive. So you'd be looking at technology stocks, you'd be looking at consumer discretionary stocks. Perhaps to a degree you could be looking at financial stocks, but you certainly wouldn't be looking at the defensives like utilities or real estate. Then from 2004 through to 2007, there was a period where the market was fairly fairly evenly balanced between those two sectors. So observing that, that's a long period of time. So you had plenty of warning that if this ratio were to break down, that would be very serious for the market. And that breakdown actually did occur in October of 2007. So you had nearly a year's warning of the crash in 2008 just by observing this chart. You didn't need any other magic formulas, or you didn't need some guru to tell you what was going on. You just needed to observe this chart and be open-minded to what it's telling you. We then obviously hit the bottom in October, November, which was well before the bottom of the market. And you can see in early November, consumer discretionary stocks started outperforming. So you could have started moving money back into selected sectors of the market about 4 months before the bottom of the GFC. So that would have been a huge advantage. You know, there was a lot of money to be made in that period from November to March when the GFC officially ended, because a lot of stocks were coming off being ridiculously oversold, and so on and so forth. I won't walk through the whole thing because I've got other charts to show, but you can see that if you just step back and take a big picture view, it can give you a very good idea of where the money flows are going. Now, right at the moment, we've got a consolidation going on, but we have returned roughly, we're closer to the top of this consolidation than the bottom. So we're in a period of sideways movement and have been since the start of this year, but it's more positive than negative. Now, the other key chart that I like to look at is the Russell 1000 growth versus 1000 value. And from 2000 to 2007, we saw growth stocks underperforming. And this, of course, is when the NASDAQ crashed. And so we saw a long period of underperformance, even though we did have a cyclical bull market during that period. We then rebounded very strongly from February of 2007 to April of 2009 in terms of growth. We then had a long flat period through to 2017, and then growth versus value absolutely took off. Now, we did have obviously a significant pullback once the vaccines became available, but look where we are now. Growth versus value. Growth is absolutely killing value again. You can see by the steepness of the line. So we've had a period now from sort of May that growth has done far, far better. So by looking at those sort of ratios, it gives you a huge benefit on where the money flows are going. Now, this is the final one I want to show, and that's the relative comparison of the American sectors. So on the top, we've got technology, then we've got healthcare, then we've got consumer discretionary, then we've got the S&P. So over the last 5 years, technology and consumer discretionary have beaten the S&P 500. Below that, we've got financials, industrials, materials, healthcare, consumer staples, utilities, and then energy right at the bottom. So that is how it has looked over the last 5 years. Now we can zero in on this a bit more because that's too big a time period for most people. And just zero in here. Okay, so let's come into the last year. There we go. And you can see that in the last 12 months, we had a period where we've had a lot of chopping around. Now, overall, finance is ahead. Technology is sort of in the middle of the pack, but technology was outperforming for a period. So we can use all these relative strength charts to indicate where the money is flowing at any point in time. So let me move on. So then, once we've decided what the bigger picture of the market is doing, and whether we should be playing hard or not playing hard, then the next question is, and we've then also decided, well, which are the sectors that we should be going hard in, And it then comes down to stock selection. Now that's relative to your main criteria, and everyone is to a degree different in this respect. And so you just need to sit down and think about what you're trying to achieve from the market. What is the sort of return you're trying to achieve? What is your tolerance to volatility, etc., etc. So you need to answer all those questions first. Questions around purpose for the transaction. Is it for capital gain? Is it for a dividend? Is it for a short-term or a longer-term transaction? Is it for trading? So you're going to structure it purely on the technical chart, or is it also for investing, where you can do both? You can understand the fundamentals, and you can also use the technicals to advantage. So all those things need to be decided first, and then you go and find the stocks that fit those objectives. All right, so that's the first part. In the next video, I'm going to be looking at triggers for entry, ideal setups for short-term trading or longer-term investing, whether you hold a core or a trading portion, which is a technique that I like to use and I think is psychologically an advantage for most people. All right, so that's the first in a probably a fairly lengthy series of educational components in this weekend video. So just wrapping it up, we're in a pretty tricky period. We've got seasonal weakness, August, September, mixed with a potential sell the fact reaction from the market, whereas once earnings season is over, and you know, history does, the data does show that 80-90% of the gains in most sectors, particularly technology, occur in the 1 month leading into earnings season. And then they're pretty much flat for the next 2 months after earnings until the same game gets played into the next earnings season. So, you know, we've got that to contend with, that a lot of the good news has been priced in, and therefore prices might go sideways to slightly down. And then we're mixing that with an amazingly strong earnings season and on the whole, very good outlooks as well. So it really is a tricky period to negotiate our way through. So from my perspective, I intend to treat each transaction just on its merits as the ball comes down the pitch, and just look at it with an open mind. Our portfolio analyst last week, we talked a lot about purpose and game plan because it's just so important. And there was another addition to the enduring growth portfolio that I'm pretty excited about as well. For anyone that's not taken the trial on Portfolio Analyst, I think you'll find a lot of benefit in there. And it's 2 weeks for $1. I think it's well worth doing. There's my details on website and email address. And I'll be back with you next Sunday. Cheers.